Kia ora, ngā mihi nui kia koutou katoa. Welcome to what is the second to last episode of Lunch Money for 2021, brought to you by Shareises. So at Shareises, our purpose is to create financial empowerment for all.
For those of you who are new to Lunch Money, we do these every Thursday at lunchtime. And this is a place where you as investors can hear from the people leading some of the companies available on the Shareises platform, as well as other investing experts from around New Zealand and Australia.
Lunch Money is also available as a podcast on Spotify, Apple Podcasts, and Google Podcasts. And please, if you are listening to the podcast, if you're able to take a moment to leave a rating and comment on Apple Podcasts, we'd really appreciate it. So my name is Alice, and I am a financial analyst here at Shareises.
And my name is Shak, and I'm in the investments team at Shareises. Before we get into today's discussion, we do have a small legal disclaimer. Investing involves risk. You aren't guaranteed to make money, and you might lose the money you started with. Any information we provide is general only and current at the time. And if you're looking for help with your investment choices, we recommend talking to a licensed financial advice provider. We won't be providing any personalized advice as part of this webinar.
Also, just as a quick reminder, if you have any questions for our guest today, you can submit them through the Ask a Question button down below. But please don't leave questions in the discussion area, as they're likely to be missed.
And please be kind and respectful towards our speakers and your fellow viewers today. Otherwise, we may need to take steps to remove you from the webinar.
And we really don't want to have to do that. But today we're joined by Mary Jo Vergara, who is an economist at Kiwibank. So Mary Jo's here to have a general chat about the New Zealand economy.
We thought that since it's almost the end of the year, it's a great time to reflect on the year that's been and what the key things impacting the economy might be at the moment and what it's looking like for the year ahead. So welcome, Mary Jo.
Kia ora, everyone. Really excited to be speaking to you both today. Thank you so much for having me on.
Well, no, thank you for joining us. It's really great to have you here, and I'm really looking forward to this chat. But just to start things off, can you tell us a little bit about yourself and your journey to becoming an economist?
Sure. So I guess my story of how I became an economist really starts in high school. I actually took it without ever intending on doing anything with it, not going anywhere with it. I took it at my dad's request, but I slowly grew to enjoy it. I think the theories and the theorems just kind of clicked with the way that I saw the world. And I took it so far that I went and did a master's in it at Auckland Uni. But after 5 years, I thought it was I figured it was time to be an adult and start getting a job. So I started I landed my first gig at an economic consulting firm, which is really a really good place to start. There was a big focus on environmental economics. I learned a new way to code. I learned how to use a coffee machine. So a lot of lifelong lessons learned in that first job. But then this opportunity came up at Kiwibank that I knew I just had to take. And I guess it's now been close to 2 years. I'm sitting in Kiwibank's trading floor alongside our treasury and financial markets team. And as someone who's relatively new to the world of financial markets, I just sit there and just like soak up all the terminology and intelligence in the room like a sponge. But the past 2 years have been incredibly interesting times. I feel like I've had a 30-year career in just the span of 20 months, but it's been a whole lot of fun. I've probably been talking about COVID nonstop for the past 2 years, but it's been a good time.
And I mean, being on the trading floor and as an economist, like, what do you actually do in your role?
My role, it's a lot of spreadsheets, writing about the New Zealand economy, no surprises there. We sort of try to understand what makes the New Zealand economy tick, what makes it hum. We look at GDP, we do some forecasting. We talk about financial markets, where do we think rates are going to go, the New Zealand dollar as well. But in between GDP and COVID and Reserve Bank announcements, we do squeeze in some research. I'm currently working on something around climate change and coastal flooding and what that means for New Zealand's financial system. So that's been very interesting and educational, a little intimidating, a little scary at times, but it's been very interesting.
Awesome to hear. So, Mary Jo, what have been the key things driving and impacting the economy at the moment?
I think number one, it's COVID, and we said that last year, but again, it's this year's main story. And just the need to have restrictions in place, it's been the biggest determinant to economic activity, which is slightly mechanical in some sense, in that if you lock up the economy, activity drops. If you reopen the economy, activity rises. So it's a bit technical in terms of COVID. But we have seen the New Zealand economy just go from strength to strength. Last year's lockdown led to the sharpest recession in our history, but now, after unprecedented policy stimulus and truly resilient New Zealand businesses and households, it's boosted our economy to where we are now, running red hot. Economic output is back at pre-pandemic levels. Of course, a lot of the heat from the housing market, from the economy, comes from the housing market, and it's spilling over to other sectors in the economy. Demand for housing is obviously very strong, and that's seeing the construction sector bumping up against capacity constraints, trying to keep up with demand. But then also the wealth effect that comes with seeing that the value of your house has gone up 30% over the year, that's spilling over into household confidence and consumer spending. So the household sector has also been quite a strong source of economic momentum. That's of course the macro view. If you look down at the industry level, it's a bit uneven. Some industries are doing well, like construction. The export sector also is benefiting from strong commodity prices. But again, there are some industries that are still struggling. Tourism and education are always the first to come to mind, given that they're out of action given the closed border situation. So it's a bit uneven, but encouragingly though, during this Delta lockdown that we're currently facing, the New Zealand economy is holding up relatively well.
Now, I'd like to just dig a little bit deeper, because we know COVID's been around for close to 20 months now, and just get your view on how the latest COVID-19 lockdowns have affected the economy, versus the general sort of view of the last 20 months.
Yeah, we've seen some strong resilience. We headed into this latest lockdown with some strong momentum. Economic growth was at around 2.8% in the June quarter, which is a very strong quarterly move. And then throughout the lockdown, indicators are showing that the New Zealand economy is holding up in aggregate relatively well. We've been tracking consumer spending, and that's been a really useful tool to get a sort of feel of the economy in real time. And what we've seen is that our spending hasn't actually dropped as nearly as much as it did last year. And that's largely because we've all embraced e-commerce, this online shopping. Businesses have looked at their business model in light of COVID and the always looming possibility that you might have to limit face-to-face interaction. And what they've done is that in response, they've bolstered their online platform and their online capabilities. And that's allowed them to continue trading despite their physical stores being closed. And then on the other side, households, they've continued spending throughout, and I can attest to this, they've continued spending throughout the lockdown. I guess we're just more comfortable with online spending. The fiscal policy has stepped in again with that wage subsidy scheme, which we know has insulated our labour market last year, and it's continuing to do the same thing. So households are a bit more confident about job security. They're not as worried about it. As, of course, you've got a very tight labour market as well, so that's helping. We will still see a drop in GDP in the September quarter, given the lockdown. Again, that's just the nature of things, but it won't be as deep as that 11% drop we saw last year.
Awesome. And I guess looking forward now, what are the impacts that you think the COVID restrictions will continue to have, particularly as we now get the sense that the restrictions are beginning to ease quite a bit?
Yeah, it's a good thing. This move into the traffic light system ultimately means more activity can take place, and hopefully any future COVID outbreak doesn't require having to shut down the economy for an extended period of time. One thing to note is that these lockdowns do come at a cost. We may be, roaring right now, but it does come at a cost. We may be back at pre-pandemic levels, but we're not yet back at that pre-pandemic growth rate. So we still have economic scarring because of this lockdown. Our economy would have been 0.8% bigger had COVID not happened. And I guess the best way to understand that is that if you think about all those coffees, say, you didn't buy during lockdown, when the lockdown's lifted, you don't go out and buy 10 coffees all at once. And so that's that lost economic output there. We are making up for it. We've got a tight labor market, a lot of demand in the economy. Local demand is very strong, but there's definitely some scarring because of the lockdown. We can't say we came out of this unscathed.
Mary Jo, just as a quick jargon blockbuster. What do you mean by like a tight labour market? And how does that impact the economy?
Yeah, tight labor market is when we have sort of, if you want a job within reason, there's one available to you. We know that the demand for labor is very strong. It's largely because of the fact we have a closed border, and so the pool of available talent for firms is just looking inwards, and that's quickly drying up because we don't have the closed access to overseas labor. So that's fueling our labor market. If you want a job, there's a one for you, and that's switching the sort of bargaining power between more so into the employees and into the employers. But yeah, that's what a sort of tight labor market means, and it does mean that wages are set to rise materially from here, given how strong demand is for labor.
Great explainer, thank you. I'm also quite keen to dig into something else that you mentioned before, which is, of course, the property market. It's been talked about so much. I feel like every day we see, news articles about the property and the price growth in the market. I mean, what's been driving all of that growth?
Yeah, that housing market has been on absolute fire. If whoever said that rugby was New Zealanders' favorite pastime is wrong. It's property. And driving house prices over the pandemic has been really low interest rates, really loose lending restrictions. And in that environment, there's a search for yield. When you're getting sort of next to nothing when you're putting your money into the bank, you go out and you look for riskier assets with higher yield. And that's seen house prices grow 30% over the past year. The reason why those low interest rates were introduced and those lending restrictions were relaxed so dramatically was because during that time at the beginning of the pandemic, we saw a lot of stresses in financial markets, and that doing so had actually cooled financial markets and allowed more money into the back pockets of New Zealand businesses and households, and that's helped our economy get to where we are today. But I do think that the housing market has peaked. There's a lot weighing on the housing market. Right now, what's propping it up is just this little bit of fear of missing out, some residual strength from Auckland coming out of lockdown, but also some low listings. But there are signs that the market has peaked. Outside of Auckland, sales are down 22% compared to last year, and where sales go, prices tend to follow. And there is a lot weighing on the market. You've got tighter lending restrictions, rising mortgage rates, and the fact that population growth is being held back by closed border is stemming any new demand. So all of this together, everything that's weighing on the market does see the housing market go into the house prices sort of cool quite substantially, and there's a material chance of even a correction happening.
Awesome. Thanks for that. And I just want to touch on something or dive a bit deeper into this buzzword inflation that we hear all over the news, all over the world. Before we dig into it a bit more, can you just remind us all what inflation is?
Yeah, so inflation is the general increase in the prices of all goods and services in the economy. And when you see inflation increase, it means that the cost of living increases. Stats NZ collects the prices of a basket of goods, things like clothing, things like rent, petrol, and they average it out. And any change in that consumer price index, which is how we measure inflation, any change in that suggests that the level prices have increased.
Cool. And what's inflation like in New Zealand at the moment?
Yeah, inflation, it's running at the fastest pace since 2011 at 4.9%. In the September quarter alone, prices rose by 2.2%, which is the highest since 1987. And what's been very interesting is that these price gains have been broad-based. Everything from transport to housing to clothing have seen a pretty decent lift in prices. Some of the jump in annual prices can be explained by base effects, that this time last year, inflation was relatively subdued as around 0.5%, and given that COVID had depressed demand. But now you can't deny that we're in a different pricing environment now. Firms are facing rising costs because of shipping, supply chain disruptions, and capacity constraints. But this is all happening at a time when local demand is very strong. So firms are finding that they're able to successfully pass on these rising costs onto consumer prices. And this is a story that's it's not unique to us. It's a story that's unfolding across the world.
Yeah, and so can we dive a bit deeper into how the New Zealand situation compares to overseas countries?
Yeah, in the US, consumer prices rose by 6.2% in October. It's the same in Australia. I think their measure of inflation rose around 3% in the quarter. So it's been inflation that's moving markets, and it's largely because of these supply chain disruptions that we're seeing. Because of COVID, you've had to close your borders, but then it's putting pressure on supply chain issues, and that's the reason why we're seeing quite a decent lift in prices.
And as an everyday Kiwi, sort of how would this impact me?
Yeah, so I guess with inflation, again, it's the fact that the cost of living has gone up. So it's more expensive to do your groceries, to go out and travel and put fuel into your cars. It's especially tough for those with lower incomes or those with fixed incomes, people receiving pensions, but also for renters who don't gain from the rising house prices. Inflation, it's often described as the thief in your wallet, that it now takes more coins to buy the same amount of goods. So the purchasing power of your money falls, and that's sort of it's not great for trying to maintain your standard of living. It becomes more difficult.
Understood the impact, I guess, on everyday spending, and therefore it flows on to how much you can save and how much you can invest. So, how would it affect different investments like property or the share market?
Yeah, I guess in a high inflation environment, naturally people start to think about where best to put their money to maintain their standard of living, given that your purchasing power of just hard cash falls. I guess the strategy would be to look into investments that where the returns are equal or greater than the inflation rate. So when you take your money out, you sort of hedge your risk of any lift in prices between now and then. Um, that's probably the way to go.
Awesome. And lastly, some people view this inflation as temporary and not permanent. But what's your view on this?
Yeah, this whole transitory and persistent, it's a bit complicated for us. It's a little bit of both, and I think it's best summarized by our situation's best summarized by the inflation expectation survey that came out, I think, last week. And what it showed was a jump in near-term inflation expectations, but the long-term expectations sort of remain anchored at that 2% level. And what that suggests is that a lot of what we're seeing now in inflation should prove temporary. The drivers of global inflation, things like rising shipping costs and the rising energy prices, they've definitely helped propel inflation here in New Zealand, but there are signs that it's starting to weaken. The Baltic Exchange Index, which is a measure of global shipping costs, has actually halved since the start of October. So there are signs that there is sort of merit to the transitory inflation argument. But what was also interesting from that survey was that the medium-term inflation expectations also increased, which does suggest that a bit of what we're seeing is proving more persistent than we initially assumed. It could be the sort of self-fulfilling thing where you see higher prices and that's starting to become embedded in your wage and price setting behavior. So there is risk here because of how far along we are in our recovery and how strong demand is. There's risk that the near-term inflation spikes we're seeing now could prove a little persistent over time. So it's a bit of both for us.
Really interesting, and that's a self-fulfilling concept is quite interesting as well. If one person puts their price up and then you do it too and everyone else does, and that. But I mean, following on from inflation, someone or something who's going to be monitoring the situation very closely is, of course, the Reserve Bank of New Zealand, and they use something called the official cash rate, or OCR, to sort of help keep inflation, or try to keep inflation between 1% and 3% in New Zealand. And they actually made an announcement about the OCR yesterday. Can you just talk us through, what happened, what was the decision, and what it was all about?
Yeah, yesterday we had the Reserve Bank's monetary policy statement, the last one for the year. And what they did yesterday was that they lifted the official cash rate by 25 basis points, taking it from 0.5% to 0.75%. What they also did was that they signaled that many more rate hikes are to come. They published an OCR track, which sort of looks at it over a forecast horizon. And what it showed was that the cash rate is expected to lift pretty quickly, getting to 2.1% this time next year. And I guess the rationale behind their move or their decision was that in this current economic environment, emergency settings like really low interest rates are just no longer needed. When you're looking at their dual mandate of, like you said, supporting maximum sustainable employment and targeting an inflation rate of between 1% to 3%, it's clear that that mandate has been met. We have an exceptionally tight labor market and inflation is at 5%. So hiking the cash rate yesterday was certainly expected and certainly warranted. What they did also was go one step further and actually signaled that for the first time in a really long time, they might have to lift the cash rate beyond what's considered neutral, which is a 2% cash rate. And at that 2% cash rate, it's where monetary policy is neither tight nor loose. And so what they've signaled is that may have to go to 2.6%, just reflecting how strong our economy is right now, that we might actually have to tighten monetary conditions. And that's pretty astounding, that turnaround, because this time last year, we were talking about a negative cash rate. If you compare last year's MPS to this year's MPS, it's a testament to how quickly things have changed and how strong and clearly underway our recovery is.
And so, the OCR has, like you say, increased. What would be the impact of this to sort of everyday Kiwis?
Yeah, I guess it depends if you're a saver or if you're a borrower. If you're a borrower, you'll see that interest rates will continue to rise. So lending rates, like mortgage rates, will continue to rise. They may push above that 4%, sort of back to pre-COVID levels. But the good news is, if you're a saver, if you're saving up for your first home or if you're saving up for retirement, deposit rates are also expected to rise after a whole year of being pretty much 0%. So it's a good news, but it does depend on whether you're a saver or borrower. And I guess it just talks to how monetary policy, it's a blunt tool. There are winners and losers in all of this when you lift or fall or you decrease the interest rate.
And as you sort of mentioned, this move was expected. I think a lot of economists were expecting another raise, and it was sort of the question of, would it be 0.25% or 0.5%? How did people react to this news, and in particular, share markets?
Yeah, it was interesting because there was some talk or expectation of a 50 basis point hike, like you said, given the large upside surprises to inflation and employment recently, and also the length between meetings. So the next one's not till February next year. So there was some talk about maybe we should do a bit more now, given the distance between meetings. But given the uncertainty around COVID, the fact that mortgage rates have already risen quite significantly until now, and also the sensitivity that households now have around interest rate rises, given how much debt we've accumulated over the past year, that it was ultimately decided against a 50 basis point move, and instead a more cautious, measured approach was taken by just lifting it by the traditional 25 basis point increment. But in saying that, there was a pretty decent reaction in markets because there was that expectation of a bigger move. We saw the New Zealand dollar sell off that fell below 69 cents, and wholesale interest rates also fell quite substantially, especially in the short end of the curve. Given that they were positioning for a much bigger move in a much more hawkish statement.
Thanks for that, Mary Jo. And I know we touched on it a couple of times earlier. It's been a constant theme in some of your responses around the supply chain issues, and that it can cause issues for companies not being able to get the materials, contractors not being able to have the materials to build, or retailers not being able to stock their shelves. But given we're heading into the holiday season, which is traditionally a really important time for retailers and spending in general, what do you think the impact will be to the economy?
Yeah, that COVID has disrupted every aspect of the supply chain, from the manufacturing to the transportation side of things. There are bottlenecks at every point. For us here in New Zealand, I guess what the pandemic has done is it's exposed how far away we are from the mecca of international trade. Shipping companies are preferring the more profitable routes and more shorter routes between Asia, Europe, and the US than having to make all the distance all the way down to us. It does mean that it's hard to get those overseas goods into New Zealand, and it is a bit of a problem heading into the holiday season. So I think what you might find when you're doing your Christmas shopping, you might see a lot of things are out of stock. You might notice a lot of empty shelves. So a tip to the procrastinator, maybe it's a good idea to start getting your Christmas shopping in now. But I guess it does, a silver lining in this supply chain disrupted world for us is that it is an opportunity to, shop local this year and support small businesses, the local economy, which have done it tough, especially in retail, because of this latest Delta disruption.
And a slight hope. Are there any signs that these troubles are starting to ease given the release of the restrictions?
It is, I think, that announcement yesterday about our border reopening. It's a good step forward. Our borders have been closed for a really long time, and I think as our economy reopens, these price pressures and these pressures around supply chain should eventually resolve. It is a temporary thing, but it's all about timing. And I think next year we'll see a bounce back in international trade for us and for the tourism and education sector as well.
And sort of following on from that, I mean, what's the outlook like for the New Zealand economy for next year? I mean, what's in store really for the year ahead?
Yeah, I think COVID, again, it's still calling the shots for the economy, and we'll still see large swings in GDP in the near term, and that's just the nature of lockdowns. Again, hopefully, when we move into this traffic light system, we don't have to manage future COVID outbreaks in that way. But we do ultimately take comfort in how strong underlying demand is in the economy. But that's not to say we're not without any headwinds. The big headwind, of course, is the supply chain issue, labor material shortages. It's hard for some industries to eke out further growth when you just can't get the resources that you need. But hopefully that should be resolved as we open up and as other economies open up and international trade can flow more freely. Again, one big positive for next year is this reopening of our border. We finally have a date, I think, by the end of April. I think people can come in so long as you're fully vaccinated. So next year could be the year of travel. It could be the year of a bounce back in tourism and education. We know that people still want to come to New Zealand and cross us off their bucket list, and we know that people still want to come and study here in New Zealand. So it's just about getting those borders open. Of course, another thing to watch out for is the housing market. It's been a key source of economic momentum, and with rising interest rates, it'll be interesting to see how that flows into consumer spending and house prices in general.
Really interesting insights. Thank you, Mary Jo. So I think we might move on to questions that people have submitted while they've been listening in. So firstly, we've got Steve who's asking, with over $100 billion in government debt this year compared to last year in February, which was $59 billion, and the increase of inflation and further promise from the government to spend due to COVID, what is the long-term effect, in your opinion, to our economy, considering our debt is basically 1/3 of GDP?
Interesting question. We have seen our economy, our country, rack up a lot of debt over the pandemic, which isn't to be. It's expected. We were going through a difficult time, so it's proper for the Reserve Bank to take on more debt. It's not bad debt, but the thing is, compared to other countries, our debt levels are where they'd want to start. Where we end up is we've got 20%, I think, GDP of our debt, and it's set to rise further. But it's not a bad problem given how strong our economy is. It'll pay itself off, I think, in the future.
Awesome, thank you. We've got a question from Dee here around how would someone approach the decision on whether to fix their mortgage rate at the moment, considering 1 year, 2 year, or even longer horizons?
I'd say that the days of record low mortgage rates, lending rates in general, are far behind us. Again, we're in a different place now where those emergency settings are no longer needed, and the Reserve Bank has been clear that they're intending to continue raising the official cash rate, which means interest rates in the economy will rise alongside with it. We're no longer in those recessionary times, so record low interest rates are no longer needed. I think the direction in interest rates now is just up.
Cool, thank you. And this question here is from Brooke. It's about inflation, which we have talked about today, but in case there's anything else to sort of add here, but is it concentrated to certain product categories, or is it now spreading to be a wider issue?
Yeah, interesting. At the beginning, it was concentrated to just a few categories. We saw transport lift. I think transport prices lifted by 16% at one time, because it's about that link to the reopening. But now what we've seen is that it's become more broad based. So everything from transport to housing to clothing has seen a decent lift in prices. Out of the 11 categories in that CPI basket, 10 had increased in the last reading. So it is becoming more broad based, and that's reflective of how strong our economy is, how strong local demand is. So firms are finding that they're able to pass on these rising costs. What that does mean is that we might see that start to become embedded in our wage setting behavior. Workers would be demanding a greater compensation for a higher cost of living, and that could see wages rise from here. We are expecting wage growth to rise by around 3.5 to peak at around 3.5% by the middle of next year. Of course, if inflation is lifts any further, wage growth would rise substantially as well.
Cool. We have a next question here from Badia, and see if you have anything further to add based on your previous answers. But with inflation rates at around 5% when they should be closer to 2% in everyday items like groceries becoming less and less affordable, what has to be done to stable the economy?
Yeah, I think it's what you said, Alice, about how the official cash rate is a tool that the Reserve Bank uses to cool inflation. When we're in a situation where inflation is relatively subdued, you lower the official cash rate so that lending rates can fall with it, and that will hopefully stimulate demand and increase borrowing and investment. But now we're in a situation where inflation is much hotter than where the Reserve Bank would want it to be. So what they've done is lift the cash rate. Given that inflation, we're not expecting it to peak till around early next year, there's impetus to continue raising the cash rate. But long-term expectations of inflation remain anchored at sort of that 2% rate. It's just these temporary factors that are propelling it higher, and demand as well. But the Reserve Bank acts in a way by lifting the cash rate to try and cool that inflation outlook.
And this question here is from Albie. With the increase in interest rates by the Reserve Bank, how much further do you expect the rate to go in 2022?
Yeah, from their new OCR track, they're showing it to rise to around 2.1% by this time next year, and I think that's about right. I think we've got it rising to 2.5% by the end of 2023. So I think that's sort of in line with expectations. It's just all about this inflation and employment mandate that they've already met and are now at risk of sort of overachieving that they need to continue lifting the cash rate. And we think they'll lift the cash rate at every opportunity they have, February, April, and so on. So I think the outlook is that by this time next year, it would be around 2%.
Well, so given your view on the outlook over the next 12 months and beyond, like how would someone consider the decision or like weigh up the pros and cons for a decision to buy an investment property?
Yeah, what we've seen from all the responses by both the Reserve Bank and the government on regarding housing is that they're making it more difficult to be a property investor. That has been the biggest group sort of fueling the housing market. So it is, property may no longer be that one-way bet anymore, given the all that's weighing on the market. What we're seeing though is that this restriction of no longer having, you can still get your sort of mortgage repayments untaxed, is pushing more people into new builds, which I think um, is a really good move, because we know that we've got a chronic housing shortage here in New Zealand, and anything to sort of create more supply in housing in the market is a good thing for house prices.
And sort of following on from that question, we've got another one that says, how else can the housing market be influenced both in terms of supply or demand to enable more of us to afford to buy a house?
Yeah, I think it's really, I think this whole 30% rise in house prices is really showing how much of a shortage we have of housing here in New Zealand. We have a shortage around 67,000 homes. It's quickly being eroded given that demand is cooling and we have more supply coming onto market. But the fact that we've had a 30% rise is really just showing how much of a chronic shortage we have here in New Zealand. And that's where the focus should be, is to try and create more supply, more housing supply. There's just not been enough to keep up with the demand that we've seen over the past 20 months.
Awesome. Now looking to or taking to a slightly different area, this question from Bede is asking, what are some of the key indicators that shareholders, could look more closely at to understand the impacts?
Yeah, I guess it's around the pricing because how that affects their profit margins. It's been earning season. It's a close eye on how inflation and pricing pressures translate into how well firms and businesses can pass on those rising costs. So it's about whether they can pass on those rising costs in an environment where demand is strong. Firms are able to pass on those rising costs, so it doesn't eat into their profit margins too much. So I think just usually earnings is where you look to.
This question here from Quinton is sort of going back to the inflation discussion. To what extent is our inflation fueled by increases in the money supply or quantitative easing or printing more money, essentially?
That is sort of the consequence of it. What we're seeing though is that it's fueled a lot by local demand, how strong it is. The fact that interest rates have fallen to record lows has given more people money into their back pockets and they've gone out to spend. So I think it is a consequence of QE of printing more money. But what we're seeing now is right now the lift in inflation has largely been driven by temporary factors. It's more of a longer term story.
Thanks for that. And do you think, in years down the line, potentially decades, because of this debt incurred through the COVID period, it might mean that the generation or younger generations, perhaps those below 40, could potentially lose or have their pensions impacted under the excuse of KiwiSaver being in place? And that question's from Sophie.
Yeah, interesting question. We have a superannuation scheme in New Zealand, so it is protected to some extent, but the burden of debt does fall on the future generations. But the good news is we have a very strong economy that, with higher productivity, should be able to pay itself off over the longer term. But we have, it does sort of, we start to talk about intergenerational issues when we start to talk about debt. That's inevitable.
And we might make this the final question for the day. It's from Cassandra, and they've asked, do you think there will be a number of mortgagee sales in the next few years due to rising interest rates?
Interesting. We haven't seen it yet. It could be something to look out for. The housing market is probably a top topic to look out for next year, and just to see how that impacts household spending and household confidence. It'll be interesting to see how that pans out, but we haven't seen that just yet.
Cool. Thank you, Mary Jo. So thank you for joining us today, and thank you also for everyone who's been tuning in. Mary Jo, we've really appreciated you taking time out of your day to come and chat to us and share all of your insights and knowledge with us.
Oh, the pleasure's all mine. Thanks so much, guys.
Just a reminder, everyone, please also check out our daily financial podcast called Recap. It's around 10 minutes long and published at about 5 p.m. every day from Monday to Friday on Spotify, Apple, and Google Podcasts.
And we will be back here next Thursday for our last Lunch Money of the year. We will be joined by Greg Foran, who is the CEO of Air New Zealand. As I just mentioned, it will be our last episode for the year, so make sure you tune in. But otherwise, please enjoy the rest of your week and stay safe.